Okay, guys. Welcome to week 5. So for this week, we're going to be talking about derivatives contract in the foreign exchange market. I'm just going to wait for a few more minutes for people to join in, and then we can start. Okay. So if you have any questions at all, feel free to ask away.
Hi Van, how are you?
Thanks. How are you, Woody?
Good, thank you. I just wanted to ask about the mid-semester exam we have next week.
Yes.
So it's happening during the lecture time, or is it happening afterwards at the weekend, and then the exam structure, things like that?
Yeah.
About that afterwards, or?
Yeah, we can discuss that afterwards. Did I upload a document detailing the structure of the exam, of the midterm exam?
I can check.
I think I did, but if I have not, we can talk about it at the end. Okay.
Nice.
Let me double check. So if we go to midterm tests, so if you go to midterm tests, can you see the folder on LMS?
Is it going to be similar with the practice one we have on LMS, or?
Yeah. So the structure will be exactly the same. I thought you can see the midterm test folder already. Let me check again. But anyway, so the structure will be exactly the same, and the time will be from 2 to 4 p.m. on Tuesday, which is the lecture time. The exam will be 2 parts. In the first part, you have a 35-minute multiple choice section with 15 questions. And in the second part, you have 1 calculation question for 35 minutes. Okay, so the structure will be exactly the same as the practice. Yeah, so it will be conducted during the lecture time next week.
Excuse me, I got a lecture the same time as this next week, and they have a midterm as well. So I'm just trying to figure out how I can do both midterms at the same time. I guess I can email you about that a bit later, but I have a bit of a conflict with that at the moment.
Yeah, sure. So that's the next question I want to answer. So for those,
Okay.
yeah, I'm aware that some people do an econometric subject that has the same time as the lecture time for this subject. So if you do have a clash, then email me and I'll reschedule the midterm test for you. Okay.
Perfect. Thanks.
Yeah.
Thanks for that.
Yeah. So yeah, so if you have any clash, just email me. All right. Any more questions? And by the way, because of the midterm test next week, we don't have a lecture and we don't have the tutorial for next week. Okay. So all classes will not be conducted next week.
Okay.
Hi, ma'am. I just wanted to know, so the portions for the midterm would be from week 1 to week 5, right?
Yeah, exactly.
So and it will be like how we had a quiz for part 1 of foreign exchange and the forward market contract as well.
So both part 1 and part 2 will include anything from week 1 to week 5.
Okay.
Yeah, but I think because the second part is the calculation part, so you can focus on the later topics. Okay, so
Okay.
part B is a calculation section. So it will be.
One more thing, we can practice the midterm practice test n number of times, right?
Yeah, you can do as many times. Yeah,
okay.
Until the day before the actual midterm.
Okay, thank you.
Okay. All right, guys. We can talk a little bit about the midterm at the end too. But for now, let's just go through our topic today, okay? So as I mentioned before, with this topic, it's a little bit complex. So in the past few semesters, I found that it tends to be more complex than the other topics. So as a result, I wanted to discuss these contracts in detail in class with you guys, okay? So you will find that these contracts are quite important in the foreign exchange or foreign exchange risk management topic. And so this lecture will be the foundation for the next topic that we talk about, which is foreign exchange rate risk management, okay? So derivatives contracts are contracts that derive their values on some underlying fundamental, okay? So in this case, we're talking about the underlying foreign exchange market, okay? So here we are focusing on futures and option contracts that are written on the foreign exchange rate, okay? So for this lecture, we're going to be covering the futures contract and the options contract. So with options, right, in the textbook, if you read chapter 7, you will see that they will talk about the general features of the options, and then they'll talk about option pricing, okay? So for the purpose of this subject, you do not have to worry too much about option pricing, okay? So the binomial tree and the Black-Scholes model is not something we worry too much about. The main point is you want to be able to understand the use or the applications of these contracts in the foreign exchange market, okay? So with the futures contract, their payoff function is quite similar to forward contracts, which we talked about last week. The key main difference between futures and forwards is that with the futures contract, they are exchange traded. And as a result, they are subject to daily settlement, okay? So this is an important figure, an important feature of the futures contract. So if you recall from what we talked about last week with forward contracts, so for a forward contract, you can sign in a contract today, let's say for a 3-month delivery. So you're gonna hold a contract until the end of 3 months, okay? And then you settle the contract in one go, which is at the maturity date of the contract. For futures contract, you gotta calculate your profit or loss every single day based on the market movement, okay? And depending on your position, if you make a loss, you have to top up. If you make a loss that is beyond a certain level, then you have to top up your account, okay? So we'll talk about this later on. And because of this daily settlement procedure, it introduces a bit of liquidity risk for future trading, okay? So for, in contrast to forward contracts where you don't have to worry too much about liquidity, with futures trading, if you have a margin account and you trade futures, you do need to worry about a daily settlement, okay? With options contract, basically it's more like an insurance type of contract. So when you enter into an option contract, you don't have to exercise the option. You don't have to exercise the option if you don't think it's profitable. So it's not contractual in that sense. Okay, so it's more like an insurance contract. But options are a bit more costly relative to futures and forward because you have to pay a premium. Okay. So let's talk about futures contracts first. So a futures contract is, as we mentioned before, is quite similar to a forward contract. And their payoff functions are therefore quite similar. The only difference is that they are traded on exchanges, so their features tend to be standardized, okay? So the contract features are specified by the exchange itself. So some of the standardized features of futures include contract size. For example, if we trade the euro contracts, futures contract. Now, for the euro futures contracts, one contract is worth 125,000 euro, okay, per USD. Oopsie. So, and one point to note is that to avoid confusion later on, sorry, this is 125,000 euro, okay? So when we talk about a futures contract that is 125,000 euro, then we are talking about trading the euro, okay? So here the commodity currency is the euro, and we price this commodity on based on the USD, okay? So this is my commodity currency here. Second, the maturity of the contract, okay? So unlike forward contracts where you can basically negotiate with your trade partner for any delivery, with futures contract, because they are traded on exchanges, normally the maturity is fixed by the exchange, okay? So for futures contracts, typically it's traded, the maturity is every quarter, okay? So you have the June, you've got a September, December, so on and so forth, contracts. Now, finally, daily resettlement. So for forward contracts, you would trade these contracts with a dealer, right? So it's over the counter market. Whereas for futures contracts, you trade them through an exchange, okay? So from an exchange point of view, if you allow people to accumulate their position until the maturity date, it's a little bit risky, because if someone is making a loss, you can, there's a risk that they will accumulate the loss over time, okay? So for exchanges to manage this risk, they introduce a procedure called daily resettlement or marking to market, where the value of your futures contract is recalculated every day, okay, based on market movement. So we will look at one example later on to illustrate how daily resettlement is conducted, okay. Now, trading on the futures market is through a margin account, okay, which means that when you start trading a futures contract, you don't have to have the full investment in your contract. You just have to deposit a margin, okay? So with the foreign exchange futures market, the margin, the initial margin is called the initial performance bond, okay? And that's about 2% of the contract size, okay? Right. So in terms of futures contracts, you also, because it's similar to a forward contract, you've got two positions. You've got a long position where you buy the currency forward, and you've got a short position where you sell the currency forward, okay? So with a long position, here is the profit function of a long futures position. And if you compare this with a long forward position, it's basically exactly the same, okay? So when you enter into your long futures position, you're basically lock in a buy price for the currency, okay? So in this graph, let's say this is the contractual value of the pound. So by entering into this long futures contract, you agree to buy the pound at $1.4416, okay? So in the future, when the future exchange rate increases, compare with a person that does not have a futures contract, you are actually better off because you get to buy the currency at a cheaper rate, whereas everyone else have to buy at a higher rate, okay? And in contrast, if the future exchange rate is a little bit lower, then you are worse off relative to everyone else who does not have a futures contract, okay? So in this case, everyone who buys the pound in the spot market will be buying at 1.40, whereas you would have to buy at 1.4416, okay? Because you have entered into a futures contract already. For a short futures position, so once again, it's similar to a short forward. So if you enter into a short futures position, you're looking at a downward sloping line. So here you will be better off if the market moves down, okay? So if the future spot exchange rate is lower than your your futures rate, then this is when you are better off relative to everyone else in the market, okay? That's because you have locked in a sell price that is higher than everyone else's, okay? In contrast, if the market rate increases, then you are worse off, okay? So here, similar to before with the forward contract, your payoff would be F minus ST. With F is the futures price and ST is the future spot exchange rate, okay? So in terms of closing out a futures contract relative to closing out a forward contract, with a forward contract, you just hold the contract until maturity and you settle the contract with your initial counterparty, okay? With futures contract, you trade them through an exchange. So when you want to close out your futures position, you will go back to the exchange and you trade in the opposite direction to your initial position, okay? So that's how you close out your futures position. And that means you don't have to wait until maturity to close out your futures position, okay? So for example, if I have, let's say if I enter into a long futures for the September delivery of one euro contract, okay? Now, I don't want to hold this long futures until the delivery, until the maturity. Let's say I want to close out this position in 2 weeks' time, all right? So when I want to close out this position, what I would do is I would go back to the exchange. I will short one futures, one September futures for one euro contract as well, okay? So when I want to close out my futures contract, I would take the exact opposite position in the same amount of futures contract as my initial contract, okay? So in the futures market, it's very rare that people wait until the maturity to close out the positions. Normally, futures contracts are closed before the maturity, okay? So in terms of the currency futures markets, the biggest market is the CME. And if you go to the CME website, you can see the trading details of these futures contracts, okay? So similar to what we said before, the maturity of futures contracts tend to be fixed by the exchange and it's normally at a quarterly basis, okay? So you've got the March, June, September, and December maturity. So as an example, this is a trading day information on one trading day of the futures market that I took from CME. So this was on the 27th of July, okay? So what we see here on the left, if we look at this column here, these are different futures contract with different maturities, okay? This is the opening price. This is the high and the low last, the change from the previous settlement price to the current settlement price, and the estimated volume, okay? So typically with futures contracts, you will see that the ones closer to maturity will be more actively traded, okay? because this is when people are trading out of their position. Okay. Open interests are futures contract that are not closed yet. Okay. So for example, if I go to the market and I buy one and I long one August futures, then I create one open interest, okay, in the August futures contract. So this is how many remaining futures contracts that are not closed yet, okay. So one of the main distinction between the futures and the forward market is that futures tend to be more liquid because there are more people trading these contracts, okay. Okay, so we mentioned before that with futures contract, they are marked to market every day, which means that your account balance will be adjusted every day based on the gains and losses of your position, okay? So if the price goes down, the value of the long position will go down and the value of the short position will go up, which means that the long position will get their account deducted and the short position will get the account added up, okay? And vice versa. So why is that the case, right? So we mentioned before that with the futures contracts, the payoff functions are exactly the same as forward. So if I have a long futures contract, I'm looking at an upward sloping line. And if I look at a short futures contract, I'm looking at a downward sloping line, okay? So when the future, when the price goes down, when ST goes down, as you can see, if we move from the right to the left, the value of the long futures will decrease, okay? Oopsie. Let me do it again. So if the exchange rate decreases, then the value of your long futures will decrease. And so a long futures contract will lose out, okay? In contrast, if the future price, if the future exchange rate decreases, then you can see that the payoff for a short position increases, okay? So from here to here. So as a result, when you have a positive price movement, the long, if you have a negative price movement, I don't know why it keeps doing that to me. Then the long will pay, so the long will make a loss and the short will make a gain, okay? In contrast, when you have a positive price movement, it's the other way around. Okay. So as an example, now let's say we have just entered into a long position in a British pound futures contract, okay? So one futures contract on the pound is has a size of 62,500 pounds. So this is how many pounds we trade for one contract, okay? Price is quoted in the dollars, so this is a USD. The minimum price increment is 1 basis point. That means the minimum that you can change your price is 1 basis point, okay? So when we enter into this contract, the market price at that time is $1.3 per pound. And at the time that we enter into the contract, we are required to put a margin account on initial performance bond of $1,625, okay? So when we open this account, we need to deposit $1,625, okay? So if you calculate the value of this contract in the USD, if you take 62,500, which is the number of pounds that we have in one contract, and you times the current exchange rate, you will see that this contract is worth 81,250 USD. Okay, it keeps doing that to me again. I'm sorry. So this is 81,250 USD. Okay, but to trade this futures contract, you only have to deposit 1,625. Okay, and this is why we say that trading futures is a margin trading, because you only have to put a margin based on the contract size. Okay. Now, the maintenance performance bond is 1,300. So what this number means is that your account cannot fall below 1,300. Okay. So whenever the value of your account is below 1,300, you have to top up your account to the initial performance bond. Okay. Meaning that if you make a loss of more than 325, then you have to top up your account. Okay. Okay. So with the futures trading, you have marking to market, meaning that every day your account is adjusted based on how much you gain or lose. So let's suppose that after we have entered into this contract, this is how much the market moves. Okay. So let's ignore these numbers for now. Let's look at these numbers. Okay. So when we enter into this contract, the initial exchange rate was $1.3 per pound. Okay. So after the first day of trading, the exchange rate moves up to 1.301 USD per pound. On the second day, the exchange rate moves to here. And on the third day, the exchange rate moves to here. Okay. So there has been a downward movement in the exchange rate. Okay. So also let's recall that we enter into a long futures position, okay, which looks like this. Now let's suppose that these are the prices of the these are the exchange rates on the next 3 days. Let me just write down the numbers. So the first day is 1.301, the second day is 1.2980, and the third day is 1.2948. Okay. So our task now is to compute the gain and loss of our position after each of the trading days. Okay. So to recall, we started when the exchange rate was 1.3 and we enter into £1 contract, okay? And the size was 62,500 pounds. So after the first trading day, the exchange rate has moved to 1.301. Now, if I have a long position, can you tell me whether I have gained or I have lost after the first trading day?
You have lost money because it went down?
It actually went up, James.
From 1.3 to 1.2?
So the first day was 1.301.
Yeah.
So we went from here to here.
Oh, sorry. I thought that was I thought that was day one there. So, okay. 1.3 is the start and then 1.301. Okay. So it went up.
Yeah, went up. Spot on, right? So it went up. So because we have a long position, we are going to make a gain. Okay. So how much do we gain here? So for each pound, we gain 10 basis points, right? So if we take this number and we subtract this number, then this will be 10 basis points, okay? So for every pound, we have gained 10 basis points. And if we have 62,500 pounds, then the dollar amount that we gained is 62.5, okay? So here we subtract the current exchange rate with the previous exchange rate, and we times it by the contract size, okay? So how much is our account balance after the first day? Remember that we start with $1,625, okay?
Excuse me, ma'am.
Yes.
Is it the same procedure if the values goes down?
No, your value goes up.
I mean, in the format when it is going down, let's say 1.3 to 1.29 or something like that. So is it the same calculations we do?
Yeah. So with the second and the third day, you'll do the same exercise.
Okay. So we get lost there.
Yeah, exactly.
Yeah.
Yeah, spot on. So if you have a long position, when your exchange rate decreases, you are going to have a loss, okay? So if I want to calculate the account balance at the end of the first day, how much would that be?
1687.5.
Yep, spot on, right? So what I want to do is I want to add the initial account with the amount I just gained, okay? So that will be 1687.5. Spot on, guys. Now, if we move from the first day to the second day, we can see that there is a downward movement in the exchange rate, okay? So in this case, what would be my gain or loss?
A loss of 3.
Loss.
James, you
20,
can go
20.
first.
I'll let her go first. That's all right.
Nagas, you can go first.
That's 20 basis point loss.
20 basis points. No, it moves from 301 to 298.
30.
30, yes, 30 basis points loss. Exactly. So here you want to calculate the daily change, okay? You don't want to compare this with the original day. You want to compare the new rate with the previous day, okay? So here, let me just erase my ink. So here, because the exchange rate has moved down, I'm going to make a loss, and the loss is going to be 30 basis points times the contract size, okay? So that will be 187.5. So to find my account balance, I'm going to do exactly the same as before. I'm going to start with the closing balance from the previous day, which is this much. And I'm going to add with the gain or loss on the second day. Okay. So 1687.5 minus 187.5. Okay. So having done the first 2 days, can you complete this exercise with the third day? Okay. So on the third trading day, my exchange rate is 1.2948.
Is it minus 62 basis point?
It's minus 200.
Oops.
That's okay.
All right.
Yeah, that's okay. as long as you try. So here what you want to do is you want to take this rate, which is the closing price on the third day, and you minus the price on the second day, okay? Then you times it with the initial contract size, 62,500, and you get this number, okay? So once again, if I want to find my closing account balance, I would take the closing balance from the previous day and I'll add with the second day. I'll add with the gain or loss on that day. Okay. And that will be 1,300. So by the third trading day, my account has lost 325. So this is the margin call, right? This is the maintenance performance bond level. So when I reach the maintenance performance bond level, I'm required by the exchange to top up my account. Okay. So I have
how fast does that have to be? That same day or next day or until you can trade again?
So if you don't top it up, your account will be closed the next day. Yeah. So you have to make sure before the next trading day, you will make the payment.
Okay.
So if you compare, yes.
Can you please go to the previous slide? I just want to ask one thing there. The one you have written. Yeah, I just want to know what the value, like $1,625 is.
So this is based on the margin percentage. So I think this was 2.5%. So when you trade a futures contract on the pounds, you need to deposit about 2.5% of the contract value.
Okay.
Yeah. Good question. So this number is from the margin requirement, okay, for one contract. So this is a feature that is distinct to futures contract relative to forward contracts, okay? So for forward contracts, you don't need to worry about the daily gain or loss. You just hold your contract until maturity and you settle with your counterparty. With futures contract, when you trade, especially longer maturity contracts, you need to worry about this liquidity risk as well, because if you can't make a margin call, then your contract will be closed out. Okay, so you'll lose all of your money.
I just have a small doubt. So, the loss of $200. Do we subtract 1,029.80 minus 1,029.48? The answer multiplied into 62.50.
Yeah, so you take 1.2948, you minus 1.2980, and then you multiply by 62,500. So this is your contract size.
So we subtract 2,948 minus 2,980.
Yeah.
Doesn't go the other way around.
So this is a long contract. So when your exchange rate goes down, you make a loss. So this has to be a negative number.
Okay.
Yeah. Yeah. So technically it comes from this equation here, right? So this is a payoff function for your futures contract. So your current exchange rate is always on the left, and then the previous day will be on the right. Okay. So where were we? So we were talking about the liquidity risk of futures contract. Okay. So with futures, this is something that you have to think about. Okay. So the benefit is you don't have to have the full initial investment to start trading futures. You only have to deposit a margin. Okay. In this case, you just have to have 2.5% of the initial contract size to trade. But once you start trading, you need to think about liquidity risk. Okay. Right. So to sum up with
Excuse me,
the, yes, Vivek?
Is it 2.5 or 2.6 in this case?
I can't remember exactly, but if you take 1,625,
I think it's 2.6.
yeah, so you divide it by 82,000 and I think 250, which is the contract size, then you get the initial percentage.
I thought the contract size was 62,500.
So that was the pound. You want to convert it back to the USD.
Okay.
Yeah.
I mistook it. Thank you.
Yeah.
Thank you for the clarification.
Okay. So, so if we want to just compute the cumulative gain or loss after the first 3 days of trading, you can just sum up the daily gains and losses. So for example, from the previous calculation, these are my daily gains or losses, okay? So by the end of the third trading day, I have made a loss of $325 in total, okay? You can also do a shortcut. So what you do is you take the trading, the exchange rate on the third trading day, and you minus the initial exchange rate, and then you times it by the contract size, all right? You still get the same answer. Alternatively, you can get the closing balance on the third trading day, and you minus it with the initial account balance, and that will also give you the gain or loss after 3 trading days. Okay. Okay. Any questions so far with futures contracts? Are we okay with this exercise? Okay. Didn't hear anyone. So, all right.
These
So
procedures at last were pretty easy, ma'am, when compared to the first one. Like,
yeah.
You have gone through the multiple calculations and got the answer at last.
Yeah,
But these gave the direct answer.
Yeah, you can. But realistically, with futures trading, you have to calculate your position every day, right? Because of the daily marking to market.
Yeah.
Yeah. So yes, you can do just a shortcut and calculate the beginning and the end value. But if you want to compute how much you gain or lost every day, you still have to go through the process. Okay, so if we are okay with this calculation, let's do an exercise and let's see if we can do this exercise ourselves, okay? And after that, we can take a short break. So with the poll that I just shared with you, we have a similar question here where we trade the yen futures, okay? So in this case, my initial price is 0.8011 per 100 yen. My initial margin account is $2,000. I have the exchange rates for the next 3 days. I've got the contract size as well. So the question here is, after 3 trading days, what is the balance of my account? Okay, if I have a short position. So in this question, we are only asked to compute the account balance at the end of the third trading day. So you don't have to compute the daily gains and loss. You just have to compute the final ending balance. Okay.
2,325.
Yeah, you can put your answer in the poll. I'm just gonna wait a little bit for everyone else to finish the answer too. Thanks, Nekis. Just be careful that this is a short position, okay? So yeah, so you can make a gain or loss. All right, let me share the results with you guys. So the majority of us chose answer C, which is similar to Nekis, 2,325. Nekis, can you explain to us how you got the answer?
So that's a short position, and we have to calculate the basis point, and at the end of 3 days, that's 0.7985 minus 0.801111, and this amount times the initial investment, which is $2,000.
You want to times the contract size, I think.
And then plus it, add it to the initial investment. So that's the gain.
Yeah. So you take the difference between the exchange rate and then you times the contract size and then you plus with the initial account balance. So that should be 2,325. Okay, spot on, guys. Let me stop sharing the results. So we have talked about the futures contracts, okay? So we want to take a short 5 minutes break, and then when we come back, we can talk about options, okay? So let's come back at 55.
All right.
Okay, let's come back to the second part of our lecture. Let me check the questions first. Yeah, okay. Right, so the second type of contracts that I want to talk about is the options contract. So with options contract, it's the right but not the obligation to buy or sell a given quantity of asset in the future at prices agreed upon today. Okay, so in the context of the foreign exchange market, we are talking about the right to buy or sell a currency. Okay, so here this is a currency. So an option gives the buyer, so the long positioned, the right but not the obligation to either buy or sell. Okay. So with options, you've got two types based on whether you want to buy or sell the currency. So a call option is an option that gives you the right to buy the currency at the price agreed today for a future delivery. Okay. A put option is an option that gives you the right to sell the currency. Okay. So in terms of payoff, a long call option has a similar payoff to a long forward. So I said similar because when it is exercised, the payoff is exactly the same as the long forward position. Okay. A put option is an option to sell a currency. So in terms of the payoff function, it is similar to a short forward. Okay. So here you're talking about selling a currency at a fixed price for a future delivery. Okay. Now, it's a little bit confusing in the options contract because you have long and short, and then you have call and put. Okay. So when you long an option, that is when you buy the option itself, right? So this is not about the currency. So when you long an option, you buy the option itself. And when you short an option, you sell the option, okay? So you don't sell the currency, but you sell the option. So when you long an option, it's similar to buying insurance. So you buy the option to exercise the contract, okay? So the buyer or the long position in the option is entitled to the right. And because of that right, they need to pay a premium to the seller of the option, okay? So it's similar to a person buying an insurance. For a short option position, or you can say write an option or sell an option. So for this position, you write the option for the buyer and you get paid the premium, right? But you have to stand there ready for the buyer when they exercises the option, okay? So when you sell an option, you create an obligation for yourself. And in exchange, you get paid a premium. So this is similar to if you think about car insurance, for example, okay? So when you buy a car insurance, you pay premium to the car insurance company and you get to claim when you have a car accident, okay? The insurance company, on the other hand, they can't choose when to exercise, when to pay out your claim. They have to pay out your claim when you claim against them, okay? But in exchange, they get paid the premium. Okay. You also have European options and American options. So they are different in the time when you can exercise the option, okay? So with European options, you can only exercise the option at maturity, whereas with American options, you can exercise anytime. So because the American options are more flexible, they tend to be more expensive as well, okay? Option money nets. So when you see the word money nets, we're talking about whether the option is profitable if we want to exercise the option right away, okay? So we'll look at an example later on, but this is the value of the option for immediate exercise, okay? So if the option is profitable when you exercise it right away, then we say that the option is in the money. In contrast, if it is not profitable to exercise the option now, then this is when the option is out of the money, okay? When the option is at the money, this is when the exercise price is exactly the same as the market price, okay? So this is the point at which you're indifferent between exercising and not exercising the option. Okay. So in terms of currency options, so it's similar to futures, currency options tend to be traded on exchanges as well. And because they are traded on exchanges, normally their contract size is fixed, okay? So for example, if you want to trade Australian dollar options, then each of the contract is going to be 10,000 Australian dollars, okay? So it's similar to what we talked about before. Now, when you see a contract size of 10,000 Australian dollars, this is going to be your commodity currency, okay? So you're trading the Australian dollars and you price the Australian dollars in the USD, okay? So this is USD over Australian dollars. Right. So in terms of option value, so at the expiry date, the American option and the European option with similar characteristics is going to be worth the same, because in this case, you only have 1 day to exercise anyway, which is the maturity date. With the call option, this is when you decide to, so this option gives you the right to buy a currency, right? So when do you want to buy a currency under an option contract? So when you look at a buying decision, right? So when ST, or when the exchange rate is higher than the exercise price, this is when buying the currency is cheaper under the option contract relative to the spot exchange rate market. Okay, so as a result, for a call option, a long call option position would exercise the option when the future exchange rate is higher than the exercise price. Okay. In contrast, with a call option, if you have a long call, you would not exercise this option if the exercise price is greater than the spot exchange rate. Okay. So when E is higher than ST, you would not want to buy the currency under the option. You would just buy it in the spot market because it's cheaper to do so. Okay. So in this case, with an option contract, you've got 2 scenarios. In the first scenario, when ST is greater than E, this is when you want to exercise your option. Okay. And if you exercise the option, your payoff is going to be ST minus E. Okay. So this is how much you are better off relative to everyone else in the market. In the second scenario, when you don't exercise the option, when the option is out of the money. So in this case, it is when ST is less than E. So if you don't exercise the option at all, then this is when the option is going to have a 0 value, right? You're not going to do anything with the option. So as a result, because of these 2 scenarios, if you want to write the payoff function for a long call option, then it will be given by the max ST minus E and 0. Okay. So what it says is that the option value is either going to be 0 if you don't exercise, or it's going to be ST minus E if you decide to exercise. Okay, whatever is higher. Now, if you compare this payoff with a futures or forward payoff, you will see that the payoff for an option, a call option, a long option, sorry, is going to be capped at 0. Okay, so you're not going to make a loss. You either make a gain or you don't make any profit. Okay. For the put option, it's the opposite. Okay, so in this case, this is the option to sell a currency. So you would want to sell a currency using a put option if the price under the put is higher than the price you can sell in the market. Okay, in other words, if E is greater than ST, then you want to be exercising the put option. Okay, so if you exercise the option value is going to be E minus ST. In contrast, if you decide to not exercise the option, so this is when it's better off for you to sell in the spot exchange market relative to selling the currency using the option. Okay. So this is when the spot exchange market, the spot exchange rate is greater than E. Okay. So in this case, you will not want to sell. You will not want to exercise the option because it's better off to sell in the market. So if you don't exercise the option at all, then the value of the option will be 0. Okay. So as a result, the payoff function for a put option is going to be max E minus ST or 0. Okay. So when you don't exercise, the option is not worth anything. When you exercise the option, you're going to earn a profit, which is given by E minus ST. Okay. So once again, it's a bit different from a short forward position. With a short forward position, you can make a loss, right? But with the put option payoff, the minimum profit is going to be 0, okay? Because you can choose to not exercise when it's not profitable to do so. So to put it in the graph, so we mentioned before that the so here I'm talking about a call option, okay? So we mentioned before that with a long call option, my payoff function is going to be max ST minus E and 0, okay? So here, if ST is greater than E, I exercise my option, in which case I'm going to earn a profit of ST minus E. Alternatively, if ST is less than E, I don't exercise my option, in which case my profit is going to be 0, okay? Now, because I have to pay an option premium, so besides the gross profit that I can earn from the option itself, I have to deduct the option premium, right, from the gross profit. So if I call C my option premium, then my net profit is going to be the gross profit here minus the option premium, which is C, okay? So if I put it on the graph, I will see that my payoff is going to look like this. So on the left-hand side, this is when ST is less than E. And this is when I decide to not exercise my option, okay? So here my option is out of the money. So if I don't exercise my option, therefore, my payoff is going to be 0 minus C, okay? So because C is a constant, I'm going to just have a flat line over here, okay? Now, when ST is greater than E, so on the right-hand side of my graph, this is when ST is greater than E, right? So when this is the case, it will be profitable for me to exercise the option, in which case my profit function is going to be ST minus E minus C for the option premium, okay? So this line over here is ST minus E minus C, okay? So if you compare this with a long forward payoff, if I have a forward contract instead, then I'm looking at this payoff over here, okay? So on the upside, I will still make a gain, but on the downside, I will make a loss, okay? Whereas with the option contract, I basically minimize my loss, okay? Now, for a short call position, I'm looking at the blue line over here, okay? So with a short call position, because it's the counterparty to the long call position, so the payoff function here is simply just the reverse of the long call payoff, okay? So if I want to find the payoff for the short call position, I'm going to just take the opposite of the payoff for the long position. It's a little bit messy, sorry. Here we go. Okay. Does that make sense, guys? So for a short call position is the counterparty of the long call. So the payoff function for the short call is exactly the opposite to the long call. Okay. And that's why I take minus the payoff of the long call. So here I'm going to write C minus max ST minus E and 0. Okay. So if I want to find a payoff function for the short call in two different scenarios similar to before. So when ST is greater than E, I'm looking at the right-hand side of the graph. Okay. So this is when the option is in the money. So when the call option is in the money, the long position will exercise the option. Okay, so the long position is here. So as they exercise the option against the short position has to pay, right? As a result, for the short call position, it's a downward sloping trend. So the payoff function here is given by C minus ST plus E. Okay. Let me rewrite it properly. So here my payoff function is C minus ST minus E. Okay. So this is the payoff of the long position. And because I've got a short position, it's the opposite. Okay. So here I'm gonna break the brackets. And it's going to be C minus ST plus E. Okay. So for a short position, therefore, when the exchange rate is greater than the exercise price of the option, I'm looking at the downward trend of that. Okay. So in the second scenario where ST is less than E, so I'm looking at the left-hand side where the option is out of the money. Okay. So when the option is out of the money, the long position will not exercise, which means the option payoff is going to be 0. So for a short call position, my payoff function is going to be C minus 0. Okay. So C is how much I get paid in the option premium, regardless of whether the long option exercises or not. And 0 is the option payoff when ST is less than E. Okay. So in this case, when the option is on the left, so when it's out of the money, my short payoff is going to be a flat line. Okay. Which is exactly the opposite to this flat line here. Okay. Sorry. So to find out the profits for an option position, it's a little bit more complex than the futures or forward contract because you have to decide whether to exercise the option or not. Okay. So your profit function depends on whether you want to exercise the option or not. Let me erase everything to make it clear. So one more thing. Now, because we have to pay the premium, right, as a long forward holder. So so I will start to exercise this option as long as ST is greater than E, but I will only break even when the exercise price is more than E plus C0. Okay, that's because besides the exercise price, I need to take into account how much option premium I have to pay as well. Okay. So as a result, I would only break even if my if the exchange rate is going to be greater than E plus C. Okay. So with a put option, we can do the same analysis and we will find that the put option payoff is going to look like this, okay? So for a long put option, on the left-hand side, we've got a line that is similar to a short forward. And on the right-hand side, we've got a flat line, okay? With a short put, it's exactly the opposite to a long put, okay? So on the left, when the option is in the money, this is when I potentially can make a lot of losses, okay? On the right-hand side, when the long put holder does not exercise the option, the short put position will be a flat line. That is the opposite to the long put flat line, okay? So if I want to write down the payoff functions for the put options, for a long put, it's going to be max E minus ST, 0, minus the option premium, okay? So here, because I buy the option, I've got to pay the premium. So my net profit is going to be the difference between my gross profit and the option premium. To find the payoff function for a short put, I'm going to take the opposite to the long put position. So that will be P minus max E minus ST and 0, okay? So with option contracts, as you can see, if we just focus on the long put option here, we can see that a long put can make a lot of gains, right? So when the exchange rate is less than the exercise price, you can potentially make a lot of gains. At the same time, when the market moves against you, so when the exchange rate is greater than the exercise price, this is when you potentially can make a loss, right? But because with the option, you can choose to exercise or not. When the market moves against you, you can choose to not exercise the option, right? As a result, your losses are going to be capped at P0, okay, which is the option premium. So the maximums you can lose on a put option is just the premium that you pay on the option, okay? Similarly, with a call option, you can make a lot of gains when the market moves up, and when the market moves down against you, your maximum loss is going to be just the call premium, okay? In contrast, if you compare that with a forward contract, you can potentially lose a lot on a forward contract, okay? Any questions so far, guys, with option payoffs?
Yes, please.
Yeah.
Input section.
With the put section.
Yeah, would you explain the intuition towards short put and long put in exchange market, please?
Yeah, sure. So with a put option, if you buy a put option for currency, then you agree to sell the currency forward, right? At a fixed price, E. So here, because you enter into a contract to sell the currency, if the market moves down, right? So if the actual exchange rate is lower than your exercise price, this is when you are better off relative to everyone else, okay? Because you get to sell the currency at a higher rate. So as a result, for a long put option, it is going to be in the money when the market rate is less than the exercise price, okay? So here, when ST is less than E, this is when your long put position makes a profit. Okay, that's because you get to sell the currency at a higher rate relative to the market, to the spot market. So in terms of payoff, when the exchange rate is less than the exercise price, your payoff function here is going to be similar to a short forward. Okay, so here.
No, I know the payoff, just the intuition of short put and long put in exchange market.
Intuition as in when you're going to use which contract.
Yeah, in exchange market for these two, specifically put.
Yeah. So say I can use, if I think that the future exchange rate is going to depreciate, right? So if I think that the spot exchange rate is going to go down in the future, and if I want to make profit, I'm going to enter into a short put, a long put option. Okay. So if I get a long put option, and if the exchange rate is actually going to depreciate, then I'm going to make a profit here. Okay.
So
now,
they are commitment to buy from me?
Yeah, so if I exercise the option, then the short position has to buy from me. Yeah. So whenever the long position exercises the contract, the short position has to honor the contract. Okay. The intuition for why you want to enter into a short put is because you want to earn the premium here. Okay. So it's similar to why insurance companies want to sell you insurance. Okay. So for a short put position, if I sell a put contract, then my expectation is the exchange rate is going to appreciate. Okay. So the exchange rate is going to increase in the future. And so I'm going to earn this premium, and people are not going to exercise the put option against me. Okay. Whereas for a long put, the expectation is the opposite. Is that clear, Nakis?
Yes, thank you.
Yeah. So where were we? We are here. All right. So we talked about the payoff functions for options before. And like Nakis asked before, it's very important to understand when you want to use which option, okay? So for example, here, you want to have a long put when you expect the market to go down, okay? And vice versa. Right, so in terms of option value, if you want to value an option, you can decompose an option value into two, an intrinsic value and a market and a time value, okay? So the intrinsic value of the option is how much the option is worth if you exercise the option straight away, okay? So for the in the money options, for example, if you exercise this option straight away, you're looking at this graph over here. Whereas for out of the money call options, the intrinsic value is basically 0, okay? So besides the immediate value of the option, you have something called a time value as well, which is this bit over here, okay? So the time value of the option refers to how likely it is that the option is going to move in the money, okay? So the time value of the option tends to be higher if the option maturity is longer, okay? So the longer time you have, the more likely the market is going to move in your favor. Second, the time value of an option depends on the current exchange rate itself, okay? So for example, if the current option is very much out of the money, right? So if the current exchange rate is right here, it's very hard for the exchange rate to move up here, okay? So in this case, even if I wait a little bit longer for the exchange rate to move, the chance that it moves in my favor is going to be quite small relative to when I am here, okay? So if the exchange rate is currently here, there is a bit more chance that it is going to move in my favor, okay, compared to here. Similarly, if you look at the other extreme, which is when the option is very much in the money. So this is when the option value is very high already. So as a result, if I wait a little bit longer, it actually could be a little bit riskier for me to wait, okay? Because the option value is not going to increase too much further. But the more I wait, the more likely it's going to decrease, okay? So the time value of the option is going to be larger the closer the exchange rate is to the exercise price, okay? So when the exchange rate is somewhere around here, then there is more probability that it's going to move in my favor, okay? As a result, the time value of the options is going to be a little bit higher here. Okay. In terms of option contract trading, if you go to the CME again, you will see that they have some information on option trading. So what I did was I took out some examples of the euro options, and it is here, okay? So in the first column, you've got the strike price of the option. In the second column, this is the type. So I'm looking at call options, okay? So with option contract, it's a bit more complex relative to futures. You got to choose the expiration of the option, okay? Anything else? So the other information is quite similar to futures contract, okay? In terms of trading volume, the liquidity in option market is not as great as the futures market, okay? It could be because options is a bit more complex to trade. So yeah, so trading in options market is not as active as the futures market. In terms of the informativeness, in terms of information, it is also harder to get information from the options market as well. So if you want to do some research in options, it tends to be a bit harder to do, okay? We are at 30. So to summarize this lecture, in this lecture, the main goal that we want to achieve is we want to understand the key features of forward, futures, and options contract, okay? Especially those related to currencies. So the main idea of forward, futures, and option contracts, they are derivatives contract, meaning that their value is going to be depending on an underlying asset. Okay, in this case, it is the currency. Forward and futures are quite similar. The only difference is their liquidity. Okay, so with forward contracts, you trade with dealers, and with futures, you trade with exchanges. But their payoffs are going to be quite similar. With futures contracts, as we mentioned before, one of the key things that you have to worry about is the marking to market of the futures positioned, and as a result, the liquidity risk that comes with it. Okay. In terms of the use of derivatives contracts, either forward, futures, or options, they could be used for speculating or hedging. Okay, So with speculating, this is when you have an expectation for the future movement of the exchange rate, and you want to take advantage of your expectation. Okay. With hedging, you have an underlying asset, an underlying position that you want to protect, and you use these contracts to protect your position. Okay. Options are a little bit different from forwards and futures. So they are the right, but they are not the obligations. Okay. So when you buy an option, you have a right to exercise the contract or not. And because of this flexibility, you have to pay a premium to obtain an option. Okay. So typically for a corporation that wants to hedge their currency exposure, normally they will be buying options. Okay. So they don't really sell options, because by selling an option, you're exposed to exchange rate risk. But when you buy an option, you have a chance to hedge your exchange rate risk. Okay. Options are also exchange traded, meaning that they tend to be standardized as well. Comparing options and futures, I think the futures market tend to be more liquid than the options market. Okay. So for the purpose of this subject, you are going to need to understand the features, the payoffs of these contracts, as well as when to use which. Okay. So when you have a problem, for example, to use an option contract to hedge a position, you need to understand which position to enter into. Okay. Any other questions with the lectures so far? All right. If there is no more question, let me move on to our tutorial. Oh, before that, I've got some poll questions to check our understanding. Okay. So we have talked a lot about option payout, so on and so forth. Let's look at this example here, where we have an option on the pounds, okay, on the euro, sorry. So in this question, we have a call option on the euro contract. We're given information about the strike price and about the option premium. And we are asked to compute at which rate do we break even, okay? So at which rate does our profit equal to 0, okay? So I've got 14 answers so far, and we have spent 2 minutes and 30 seconds on the question. Okay. 18. All right. We are at 3 minutes, so I'm going to end the polling for now, and I'm going to share the results with you guys. Okay. So most of us got the answer right, which is answer 8. So congratulations, guys. So here we are dealing with a call option. Okay. So I'm just gonna go back to the call option payoff. Now, because we buy the option, in this case, it doesn't matter if I buy or sell, but let's look at a long option first, okay? So on this graph here, if I look at a long call option, this is the point at which I break even, okay? So when I exercise the option, and when the exercise price, when the exchange rate is equal to the exercise price plus the option premium, this is when I break even, okay? So to find why it is the case, now the break-even point is the point at which my net profit is 0, okay? So for a call option, if I look at the left-hand side, I'm going to always make a loss of minus C0, okay? So my break-even is not going to be anywhere here. My break-even is going to be found when I move to the right of the graph, okay? So here, when I look at the right side of the graph, this is when I look at the case when I exercise the option, okay? So when I exercise the option, this is a call option. So my payoff function is going to be ST minus E minus C0, okay? So for a break-even exchange rate, it's going to be given by this equation here. So if I rearrange, I will find that the ST is going to be E plus C0, okay? So in this case, my C is 0.08 and my E is 1.5, okay? So my correct answer is 58, sorry, which is answer A. Okay, well done, guys. Let me just go to the next question. Oopsie, what did I do? Let me go to the next question. Sorry, it's not the one. Right. So let's do this question before we take another break, okay? So in this case, we've got a similar problem, but instead of being given a C0 number in exchange, in percentage points, we're given the option premium in the dollar value, okay? So if that is the case, how do I solve the problem? Okay, so we've got 7 answers so far. So we are at 2 minutes and 30 seconds, and we've got 16 answers. Okay. I'm just going to wait until 3 minutes before we can go through this question together. Alrighty, I am going to stop the polling now, guys, and I'm going to share the results. Okay. So the correct answer here in this case is still answer A, which is 1.58. Okay. So for this question, the only difference here is that our option premium is given in a dollar term. Okay. So we have 2 ways to solve the problem here. Number one, we could just convert this dollar option premium back into the exchange rate, and then we work through the problem as before, or we could start with a dollar profit formula. Okay. So with the first method, what I'm going to do is I'm going to convert this 5,000 option premium into an exchange rate percentage. Okay. So given a contract size of 62,500, if I want to find the option premium in terms of per pound value, per euro value, then I'm going to take 5,000. I'm going to divide that by 62,500, which is the contract size. And what I've got here is $0.08 per euro. Okay. So this ratio tells me what is the option premium per euro value. Okay. So the option premium here is $0.08 per euro. So if I want to find the exchange rate, the break-even exchange rate, I'm going to take E plus C0, which is the option premium, and I'm going to get the same answer as before. Okay. Alternatively, I can start with a dollar profit figure, right? So if I want to find the dollar profit figure, I'm going to take the exchange rate minus the exercise price times the contract size, 62,500. Okay, so this is the gross profit of the option, and I'm going to deduct that by the option premium, which is $5,000. Okay, so because I want to find the break-even exchange rate, at which point my profit is going to be 0, I'm going to have this equation here. Okay, so the next step is just to rearrange the equation. So here I'm going to break the brackets, minus E times 62,500 minus 5,000 equal to 0. So E is given by the question, which is 1.5. So I'm going to substitute E for 1.5. So my SD is going to be 1.5 times 62,500 plus 5,000 divided by 62,500. Okay. So if you put this in the calculator, you will find that this is 1.58. Okay. Does that make sense?
I got a little bit lost when the last step, how you got to ST equals that division equation. Could you just explain that one more time, please?
Yeah, sure. Yeah, sure. Let me just erase it first to give me some space. And I'm going to erase this E and write 1.5 in here. Okay. So we said before that E is equal to 1.5. So if I put this in the calculator, let me pull up my calculator. 1.5 times 62,500. So here I'm going to have ST times 62,500 minus 93,750. Yeah, sorry, James, I took the shortcut before. Okay. Now I'm going to bring these numbers to the right. Okay, so here I'm going to have ST times 62,500 equals to the sum of 93,700 plus 5,000, and that will be 98,750. Okay. So here I'm going to divide both sides by 62,500. And that will give me 1.58. Okay.
All right, thanks. That makes sense.
All right, guys. Let's take another short break of 5 minutes again. And then when we come back, we can go through the tutorial questions. Okay. So I'll see you back at 56.
Okay.
Okay, so let's move on to our tutorial questions, okay? So with the futures questions, we've got problems 1, 2, 4, and 5. And with the options topic, we've got the mini case at the end of the chapter. So problem 1 relates to the daily settlement of a futures contract. So in this problem, we've got a trader that trades Euro futures, right? So here we have a short position in one contract, okay? The initial price is $1.3140 per euro. Currently, our performance bond account or the margin account is 1,700, okay? The next 3 days settlement prices are as follows. And we are asked to compute the changes in the performance bond account every day and the balance of the performance account after the 3rd day, okay? So each of the contract is 125,000 euro. So once again, in this case, the commodity currency is the euro, okay? So here we are talking about trading the euro, and we price the euro against the USD, okay? So the euro is your commodity currency and the USD is your measurement currency. So we have done this before, guys. So can you spend about a few minutes to help me fill in this table here? Okay. So what you have is you have a short futures position in one contract, okay, which is 125,000 euro. To summarize the information, this is where we start with. So we start when the exchange rate is $1.3140 per pound per euro, and our current balance is 1,700. Okay. So if the exchange rates in the next 3 days are like this, can you help me compute the daily profit or loss, and also the closing balance at the end of each day? Okay. So if you have a short futures, I'm just going to draw the payoff diagram for you. Okay. So when I have a short futures positioned, if the exchange rate depreciates, will I make a gain or will I make a loss?
Gain.
I will gain, right? Spot on. So from day 0 to day 1, I'm going to make a gain. Okay, because it has decreased, right? So if we look back to the graph, I'm moving from the left to the right. So my profit increases. Okay. So to compute the gain, I'm going to take the difference between the two rates. 126 minus 1.3140. Right, so this is the gain per euro. I'm going to times this with the contract size, which is 125,000 euro. And that will give me the dollar gain, okay? So if you have computed this number already, can you tell me what it is?
175?
175. Did everyone else have the same answer?
Yes.
From day 1 to day 2, what happened to my account? Do I gain or do I lose?
You're going to lose this time.
I'm going to lose this time. Yes, correct, because the exchange rate has increased. Okay, so if I want to compute the loss, it will be 13126 minus 1.3133. Okay, and that will be
87.5.
87.5. All right. Could someone check the answer for me, please? Did we all have the same answer?
Yeah, I got the same there. Yep.
Okay, thank you. Then moving from the second to the third day, I am going to
Lose again.
Yes.
Keep on going up. Oh no, it went down. Sorry. Yeah. So you made a gain.
Yep, so we're going to be making a gain. So similar to before, I'm just going to take the current day price. I'm going to minus it with the, oopsie, sorry, that's the other way around. So I'm going to take the previous day and I'm going to minus the current day's price. And I'm going to times it with the contract size. Okay, and what is the dollar gained?
1050.
1050? Okay. So if I want to find the closing balance on each of the days, I'm going to take the previous day's closing balance and I'm going to add the gain or loss on that day. Okay. So here, that will be 1,875. Second day, minus 87.5.
1787.5.
And then for this day, I'm going to get
2837.5.
2, 3,
28
28,
37.
37.5. Thanks, Anish.
Thank you.
So we have computed the daily gains and losses for this position. Now, if we want to compute the profit or loss after the third trading day, what do we do?
You just subtract it from your starting balance. of
Exactly right.
1700?
Spot on. So it's just the difference between this number and whatever I started with. Okay. So that will be given in the next line. Oh no, this is the closing balance on the third day. If I want a net profit, it would just be the closing day.
1137.5.
Yep. 1 point.
No, it's 113.
113.7.5.
7.5. Yeah.
Thanks, Anish. Right, so that will be the profit that I earned after 3 days. Okay. Good, guys. So we have aced the first problem. The second problem is exactly the same. The only difference here is we changed the position from a short to a long. Okay. So to solve this problem, you just have to go back and reverse the gain and loss to the opposite, okay? And then you add up the closing balance again. So for example, in the first day, now this is the change in the exchange rate after the first trading day, right? So for a long position, we are looking at this graph over here. So when the exchange rate goes down, as it did in the first day, we made a loss, right? And the loss is given by the difference between the first day exchange rate and the initial exchange rate, okay? On the second day, we make a gain, and it's given by the difference between the second day price and the first day price. On the last day, we have made a loss, so the exchange rate depreciates again. In this case, we just subtract the third day price with the second day price. So our cumulative profit is going to be the difference between these exchange rates times the contract size, okay? So if we want to find the closing balance after the third day, we take the initial balance and we plus the cumulative profit or loss, okay, over the 3 trading days. So overall, after the 3rd trading day, the closing balance is going to be just 562.5, okay. So in this case, we are not given the maintenance performance bond level, but it's likely that because our account drops by a lot, it's likely that we're going to get a margin call, okay, requesting us to top up to the initial performance bond. All right, so in the next question, we are looking at a futures contract on the Mexican peso. The current price is $0.05481 per Mexican peso. Okay. You have some expectation about the future of the Mexican peso. And in this case, you believe that this future price is going to increase. Okay. The first question here is, given your belief, what would you do to make profit? Okay. So the futures contract for a September delivery is currently $0.05481 per peso. But you actually believe that it's something else, right? So your expectation is it's going to be 0.06133. Okay. So given the market price and given your expectations, if you want to speculate, what would you want to do?
You will enter a long position, long future position.
Exactly right. So you want to be buying the peso using the futures contract at this price. Okay. So here you think that the market is pricing the peso too cheap, given that you believe that it's a little bit higher. So if the market is pricing it too cheap, you want to be buying. Okay. So here you want to be buying the futures contract and lock in a buy price of 0.05481. Okay. Now, suppose that you have already entered into your position. Can you calculate your anticipated profits, assuming that you take 3 contracts? Okay. I think the size of the contract is given here. So each of the peso contract is going to be 500,000 pesos. Okay. And you have 3. So if I have decided to buy a futures contract on the peso for the September delivery, if the future is going to be like this, how do I earn a profit?
You buy at the lower price, sell it at the higher price. So that's a long buy now, sell later.
Exactly, right. So you have already bought the peso under the futures contract here. So in September, you will get the peso from your futures contract, and then you're going to use that to sell to the market at this rate. Okay. So buy from futures. Then sell to market in September. So for each peso, the profit that you would expect is going to be the difference between your sale price and your buy price. So here is how much you sell, and here is how much you buy. Okay. So given that each contract is going to have 500,000 pesos, so for each contract, I'm going to earn this much in profit. Okay. If I have 3 contracts, I'm going to times my profit by 3. Okay. Next question. So what is the size of your profit or loss if the futures price is indeed an unbiased predictor of the future spot price and this price materializes? So in simple terms, what does the question say?
Instead of the price going up, it's going down this time. So essentially, you're doing the opposite what we just did in the last question.
So what is exactly the price in the future?
Oh, so for problem 5, the price in the futures is at 0.04829.
Oh, no, sorry. I'm still at this question here in problem 4.
Oh, sorry, we're still in problem 4. Thought we moved on.
No. We still have the last bit.
Right. Oh, that.
Yeah. So this question basically says that if the futures price, which is this price here, turns out to be the correct predictor of the future, meaning in the future, the actual spot price is going to be this much, okay? So the future spot price is going to be equal to the futures price. And this is 0.05481, okay? So in contrast, we believe that it is going to be this much, right? Now, if this is the case, if the future spot price is actually equal to the F futures price, then what would happen to our profit or loss? So we said before in step 1 that we long a futures contract, yeah? And we long at this price. So our futures payoff is going to be ST minus F, with F being the futures price. So if the future spot price, ST, is going to be equal to F, then in this case, our profit is going to be 0, right? So our buy price is exactly the same as our sell price. Okay. Does that make sense? So in this case, you just don't earn anything. Okay, in problem 5, we just reverse our position, okay? So what happened is we believe that the price is going to go down this time, okay? So going back to the questions in problem 4, the first question is, if we want to speculate, what position do we enter into? Do we sell or do we buy the futures contract?
It's a short position.
Yep, exactly. So you want to be selling a futures or
Sell now, buy later. Yeah.
yeah. So you want to be selling at a high price and you want to be buying at a low price. So the futures price was 0.05481. So in this case, because I have a short position, my profit function is going to be F minus ST. Okay. So if the future turns out to be this much, then I will make a profit, which is given by the difference between 0.05481 and 0.04829. Okay. Now, each contract is 500,000 peso, and I've got 3. So this is how much in dollar profit I would expect from my position. Okay. And the second bit is if the market turns out to be exactly the same as the futures price, then of course I don't own anything. Okay. So problem 5 is quite similar to problem 4. Right. So moving on to the options problem. So in this case, I've got a mini case from the textbook, and you can find that at the end of the chapter. So here I've got a speculator who have 5 yen call options. Okay. So here I've got 5 call options. And it's for a 3-month maturity. Okay. Now, if I want to purchase these options, essentially I want to be buying the options. Okay. So the first step I would do is I would draw a payoff function for a long call position, which is when I buy the option. Okay. So here it is, guys. So on the left, when the exchange rate is less than the exercise price, I don't exercise my option, and the option is going to worth 0. In this case, my payoff is just the option premium that I pay. On the right-hand side, this is when I exercise the option, and this is when my payoff is ST minus E. Okay, so overall, my payoff is going to be so P for payoff, max ST minus E, 0 minus the option premium C. Okay. So in this case, the strike price or the exercise price E is 96 cents per 100 yen. Okay. So here 0.96 over 100 yen. Now the premium is going to be 1.35 cents per 100 yen. So my C0 is going to be $0.0135 per 100 yen. The current spot price at 0 is 95.28 cents, and the 90-day forward rate is 95.71. Okay. We think that the yen is going to appreciate, and as a result, we want to find the following, right? So, first question. Graph the call option cash flow schedule. In other words, can you draw the call option payoff function with the proper label? Okay, putting on the proper numbers in the correct places. Okay, so you start with this basic graph here, and you want to properly label the graph based on the numbers in the question. Okay, so let's spend about 3 minutes on the graph. I'm going to share a whiteboard. Okay. So if you have your graph ready, feel free to annotate on my whiteboard so everyone can see as well. Right. I think there's an annotation function where everyone can draw, but just to make sure that it's not too messy, if you decide to draw on the whiteboard, can you let me know first? So I'm going to start with a basic function like this. And your job is to help me label the graph, okay?
Can I give you a go?
Yeah, sure, Hank. Go for it.
So this will be the strike price.
Yep.
Strike rate.
Yeah, exactly.
0.96.
Yeah.
And over here will the break even will be 0.96 plus 0.0135.
Exactly, spot on. So that will be A plus C.
Yeah, and over here will be the $1, and this will be the payoff.
Yeah, exactly. Yeah. Can you label the vertical axis as well?
This will be the spot exchange rate.
Exactly.
And this is the price thing. Yeah.
So it's not exactly price, it's the profit.
Profit.
Yeah.
Profit, yeah, sorry.
Yeah.
Where's the
And what is this point here?
This is the
Premium.
Exactly.
So
Spot
it
on.
should be 0.
So it should be a minus number here because you're paying, right, as a long call option. Okay, spot on, Hank. Thank you so much. So what I did was I drew a similar graph on my, using my handwriting, and then I took a picture. Let me try to share that with you. So this is it. How do I share through here? So if you look at your chat box, I'm trying to send the picture through the chat box, okay? Here we go. Just give me a second. I'm trying to find where the file is. Here we go. So when we are waiting, I'm just going to share the file through here too. All right. So if you look at your chat box, you will see a soft copy of this picture here. So this is where I label all the graph and I put some notes here for you for your revision, okay? So for your long position, so of course we start with this basic graph here. So this is when you start to exercise your option, okay? So this is the exercise price or the strike price. So any exchange rate beyond this point, you will start to exercise your option. Your break-even point is given by E plus C. So this is when your option doesn't make money and it doesn't lose any money as well. This is the payoff function. And here on the left, I've got minus C, which is the premium that I have to pay, okay? So in our question, if our expectation turns out to be right, and if the exchange rate is going to be $1 per 100 yen, then like Hank said before, we are looking at this point over here. So in this case, we are going to make a profit, okay? All right, so I'm going to go back to our slides. Here it is. Right, so if you you can look at the chat box and you will see the picture that I just showed you before in the chat box. So question 2, determine the speculator's profit if the yen appreciates to $1 per 100 yen.
You're still sharing the photo,
Oh,
the graph.
let me stop sharing and let me try it again. Do you see the slide now?
Yeah.
Yeah.
Okay. Thanks. So question 2, determine the speculator's profit if the yen appreciates to $1. Okay. So here you want to, let me go back to the picture. So here you want to be computing the dollar profit if you are standing here, okay? So if the spot exchange rate is $1 per 100 yen, how much is going to be your profit? So if we look at the right-hand side here, this is when we decide to exercise the option, okay? So to compute the dollar profit, I'm going to write ST minus E for my payoff minus C times the contract size. Now remember that these are prices per 100 yen, okay? So before I times the contract size, I'm just going to divide it by 100 to make sure that I'm looking at the price per yen. And then I'm going to times the contract size, which is, what was the contract size before? I think it's given in the exhibit before. So the contract size for 1 yen per USD contract is 12.5 million yen. Okay. So can you help me put in the correct numbers in these places to compute the dollar profit? Oh, by the way, we have 5 contracts, so I'm just going to times it by 5 here.
That's $1.
So ST is 1, yes.
minus 0.96.
Yep, so E is 0.096. And C would be?
0.135.
Exactly, yes. Can you help me compute the dollar profit here then, given the correct numbers?
I got 1.6563.
Yeah, let me put it in the calculator, sorry. Did anyone else have the same answer?
How much did he have? 16,562.5.
And can you confirm, please?
My answer is 1.65625 million.
Yeah, that's correct. I've got the same answer.
One.
So, this will be 0.0265 divided by 100 times 12.5 million times 5. So times 5. Yeah, so I've got something similar. So 1,656,250. Does it make sense, James?
Yeah, I just didn't add a zero on the million.
Okay. Yeah. Okay, so that was the second question. Okay, question 3. Determine the speculator's profit if the yen only appreciates to the forward rate. Okay, so here your forward rate is 95.71 cents. Okay. So if we go back to the graph that Heng helped us show, draw before, then this is the exercise price, 0.96, right? This is your forward rate, 0.9571, okay? So in this case, what is my expected profit?
That's the loss of premium.
Yeah, exactly. Spot on. So in this case, I don't earn any profit because the exercise price is greater than the spot price. Okay. So here I'm standing on the left-hand side, and because it's not good for me to exercise the option, I am going to leave the option worthless. Okay. So the payoff here for me is therefore the just the option payment, the option premium payment. Okay. So to compute how much it is, I'm going to take the option premium per 100 yen divided by 100 to get the option premium per yen. And then I'm going to times it by each yen contract size. And I'm going to times it by 5, which is the number of contracts I have. Okay. Last question, question 4. Let me go back to this slide. Determine the future spot price at which the speculator will only break even. Okay. So in this case, we went through this before, right? So when Hank helped us draw the graph on the whiteboard, we said that the break-even rate is going to be 0.96 plus 0.0135. Okay. So that was, let me put it in the calculator.
0.9735.
0.9735. Yep. Exactly, right? So this is the rate at which we will break even. All right. So this is not in the question list, but suppose we change the previous question to buying a put option instead, a call option. Okay. So in this case, let's not go through all the questions. Let's just draw a graph. Okay. So suppose we've got the same information as before, but instead of having a call option, I'm going to have a put option. Okay. So in this case, can you guys help me draw a graph and properly label it? Okay. So to start, I'm going to give you a put option payoff function first. This is too ugly. Let me. Okay. As before, can you help me label this graph? Okay.
So break even is 0.9465.
Say that again. So 0.9465. Yep, oopsie, sorry, 5. And that will be given by?
Not 0.96 minus 0.0135.
Exactly right, spot on. So this break-even rate here is E minus C. Okay. Oopsie, let's say P for put. So I'm gonna call little p the put premium. Okay. Okay. What about this point?
That's 0.96.
Exactly right. So this is E, which is 0.96. This point?
0.0135.
Okay. Okay, so this is the premium that we pay for the short position. On the vertical axis, what do I have?
Profit and loss.
Profit, exactly. And on the horizontal axis, this will be?
A spot price.
Exchange rate, yes, spot price. Guys, so in this case, I will exercise the put option if the exchange rate is going to be less than 0.96. In contrast, if the exchange rate is going to be greater than 0.96, I'm not going to exercise, in which case my payoff function is going to be minus 0.0135. Okay. And when I exercise, then my payoff is going to be E minus ST minus P. Okay. So E minus ST is this line over here. And minus P is for the payoff premium, the put option premium. Okay. All right. I'm going to send you another picture as well. It's nothing too different from before. So this is the file. So in the second picture that I just sent you, it will be similar to what we're looking at in the photo here. So it's nothing new, it's just the payoff function for a short call, okay? And here, similar to before, I put the proper label in here. So as you can see with an option writer, the gain is capped at C, right? So on the left-hand side, when the long call option does not exercise, then the short call will earn a premium of C. On the right-hand side, when the call option, when the long call exercises the option, then the short call potentially can make a lot of losses, okay? So this means that if you enter into a short position in an option, you are exposed to more exchange rate risk, okay? So as a result, for risk management, normally people will stick to a long call position, okay? If you enter into a short position, normally it's because you want to earn a profit, which is C in this case, okay? All right, I think that is it for today's class. Any questions at all, guys? We can talk about the midterm if you want, given that we have about 10 minutes, sorry.
And I just wanted to know that we have like multiple attempts for the midterm practice test, right?
Yeah, you can practice as many times as you like.
Okay, yeah.
Yeah.
Thank you.
And the topics covered includes this week or just the last 4 weeks?
This includes this week as well.
Okay.
Yeah.
And then you said part B is only one question that might have several parts to it, correct?
Yeah.
Okay.
So if you look at the practice paper, you will see some practice questions for part B as well.
Oh, okay. Yeah.
So you would expect something of similar length to the practice question.
But so that question would kind of focus on mainly one topic, correct? Or would it kind of range over several topics?
So with part B, it will be focusing on just one topic. Yeah. So one question is just one topic.
And then, as you said before, if we wanted to manage our time, we could do part B first and go back to part A, or do we have to do it A first and then B?
Yeah, so you have to do A before B. Yeah.
Oh, okay. And how much time for each then?
35 minutes each, but you have a window of 2 hours to attempt.
Yeah. So we can take a short break in between part B and A if we like. Okay.
Yeah, exactly.
Okay.
All right, guys, any more questions? If you have any questions later on, feel free to email me.
Will the exam be open for 2 hours or?
Can you say that again, please?
Will the exam be open for 2 hours or should we complete it in 1 hour?
2 hours. The total open is 2 hours, but you would only have 1 hour and 10 minutes overall to finish it. Does it make sense?
Okay, it will be open from 2 to 4 and we need to complete that in 1 hour 10 minutes.
Yeah, so the overall time allowance for each part is 35 minutes. And once you click start, you would only have 35 minutes to finish. But you have from 2 to 4 to complete.
Okay, it's on 25th, right?
Next Tuesday. Yeah, so it's the 25th.
Okay, do we have to solve the question or is it going to be a multiple choice one?
So more information could be found on the LMS. Let me talk about that point for now first. Let me go back to my slide. Right, so the topics, as we mentioned before, will be from 1 to 5. In terms of answering the second part, now this is going to be a calculation questions and you have to show your workings. So you could either type your answer in the answer box or type in the word file and then put it in the answer box. Or if you're more comfortable with handwriting, you can write your answers on a paper, take a picture, and then upload it on the LMS. Okay. Does that make sense?
Upload it to LMS.
So either way is okay for me. I'll mark whatever type of answer I've got. Yeah, but just bear that in mind when you do the practice. Okay. So
If we, I was just going to ask, if we do the handwritten and we happen to have 2 pages and 2 files, are we able to upload 2 files or try to keep
Yeah.
it to 1 picture?
no, you can upload multiple files. Yes.
Okay, great.
Yeah, yeah. So potentially you can upload as many as you want, but I don't think it's practical. So maybe too much.
No. But just in case I needed the extra page, I can do two files. If that's
Yeah. So you can upload as many pictures as you like.
Yeah.
And just in case if it doesn't work, because I've got some people having a crash when they submitted their answers in the first semester. So if it doesn't work, make sure you email me your answer on the same day. Okay. Okay, guys. Any more questions? Yeah.
Is the practice part B open in the LMS? Because I have already finished the practice part A, but it's still restricted for me for the part B. So is it wanted to check is the same for everyone or?
Did anyone else have the same problem that they can't access part B?
I haven't done A yet to know, sorry.
Okay. Let me check the setting again, but it should be open for you too. So I'll check it again. And if you still can't access it by tonight, then email me.
Okay. Yeah, that will help. Thank you.
Okay. So if you do enough practice, I think you'll be okay with the type of questions. I think it's just about time management because the questions have already been discussed in class. So it shouldn't be any surprise to you. Okay. But it's just about the time. All right. So if there's no more questions, I will not see you next week, but good luck with the midterm next week. We don't have any classes next week. We will resume the class in week 7 after the break. Okay. So if I don't see you or talk to you through email again, good luck with the midterm and I'll see you back after the break. Okay.
Thank you. See ya.
See ya.
Thank you.
Yeah, see you. Bye-bye.
Thanks, guys.
Thank you.
Thank you.